Welcome to Sense and Sensibility, the Inflation Guy podcast. I am Michael Ashton. I am the Inflation Guy, and I am your host for episode number 60. And today on the podcast, we have a live guest with us. For the first 59 episodes of Sense and Sensibility, we've had no guests other than the one posthumous interview of Milton Friedman in episode 15. You've just heard my voice and my opinion on things, and so I decided that this year I would try to bring on some other guests, selecting them from people that I've met on my travels and in my professional life, people who can talk about their own professional experiences and personal experiences with inflation as practitioners, evaluating and or managing inflation exposures, and so on. And I'm really excited to introduce my first guest coming up in a moment. But first, let me remind you that this episode of Sense and Sensibility is sponsored by Simplify ETFs. Simplify ETFs is a manager of alternative ETFs, solving today's most pressing portfolio challenges. This includes income solutions like SVOL, yield curve plays like TUA, and 60/40 diversifiers such as CTA. If you're an individual investor or an RIA, you will likely find that something they've done addresses a particular problem that you have that you didn't know was solvable. Check out their website at simplify.us. That's simplify.us. You can find their entire lineup of ETFs at simplify.us/ETFs. Okay, so let me introduce today's guest then. His name is Bill Poutsiaka. He's an old friend of mine, and he's a senior financial services guy. He's got this. I don't want to say he's old, but he's been around. He's done a lot of things. Senior C-suite kind of stuff, and he's been on sort of both sides of the table. So he's been a CEO of an asset management firm called PanAgora Asset Management, a big quantitative firm. And he's also been a CIO of a big insurance company, AIG Property Casualty, following the financial crisis, and also a CEO of another insurance company, Arkwright Mutual Insurance Company, which he merged to form FM Global. So he's sort of been around on both sides of things, both as an asset manager of a third-party asset manager, but also as an insurance dude. And I met him when he was in his AIG incarnation, and I recall that we were introduced by Peter Hancock, and I can't remember the exact circumstances, but Bill is a great first guest here because he has this deep knowledge of a subject that is insurance that I'm not as deep on, and he has a really good understanding of inflation and how those things fit together from a lot of different angles. So I think he's going to bring some great perspective to the broadcast today. And that seems like a good place to start, Bill. I mean, do you want to, first of all, do you remember why Peter introduced us? And do you want to add anything else to the background? Now, keep in mind, this is my first time in the interviewer's chair, so be gentle.
You're doing great, Mike. First, let me say thanks. Thanks for inviting me. It's a great topic. We go back at least 10 years.
It's more than that, Bill.
Yeah. I appreciate the invitation. I would say that your review of my background is correct and accurate. I would add one thing that in addition to the common thread being financial services, I've perfected the art of learning from my mistakes because I've had just so much practice at it. And as far as when we met, Peter introduced us to talk about some of the very things that we're going to be talking about today. He thought that us coming together would, with regards to how to manage risks of various types, that we could put together some programs and ideas, and we worked on those kinds of projects. Unfortunately, you impressed me as being somebody who was both technically knowledgeable and creative, and so you've gotten wrapped into my project web. And over the years, as you know, we've worked on many different kinds of, I think, fascinating projects, and unfortunately, these this web doesn't make you eligible to go into witness protection, which I'm sure you're probably want to do, given all the times I've tapped your expertise, and
well,
which
look,
I'm very appreciative.
Well, look, I mean, it's great if you can have a professional experience and a professional life that goes kind of beyond, the sort of, raw commercial professional, first interaction. And you and I have extended this in, ever since then in lots of super interesting ways. And, that's actually, I think what I want to do with this, with bringing on guests is not just with you, but I'm in a lot of webs, and I want to bring on people and talk about the webs we're in. So I think that's a great, perfect reason, that you're on, and a perfect first guest. So let's see. Now I understand that I'm the interviewer, which means I'm supposed to ask questions. And so, as you can probably already tell, this is probably we're going to riff on this, and it'll be a little less structured, but let's see how it goes.
It also doesn't preclude me from asking you questions. Is that correct, Mike?
Gosh, I guess. I mean, I sure, the inflation guy, the insurance. I mean, I guess. I mean, I'm not sure how I have to credit you then. It gets a little confusing, but yeah, but you're welcome to.
Okay.
Sure. I mean, that's how it's how our relationship has gone, right? I mean,
For sure.
I ask you about insurance, you ask me about inflation, and we both get smarter. So, now, I've always been fascinated with insurance. Well, not always, but as soon as I learned enough about insurance, I became fascinated with it. And especially property casualty is one of those industries where inflation comes into lots of decisions in lots of different ways. Do you have a particular framework for how you think about inflation in the context of the insurance biz? And then maybe we could talk about some examples or something like that. But let's start with whatever framework you bring to the table here.
Sure thing. I would say, Mike, I describe the way I look at this issue as more of an approach than kind of a construct or a framework. And I think I would introduce it by saying we all tend to race to the most obvious steps, which is to add inflation benefiting assets. That's part of the solution, but I'd like to precede that by taking a step back and with some, I guess I would describe it as organizational self-scrutiny through a series of questions. I kind of think of it as an inflation audit for an intermediary. And the questions would, I think they're pretty intuitive and common sense, actually. So they would be like, where is our inflation? Is it in operations? Is it on the balance sheet? Is it both? What is the unit that is being priced? Is it a physical unit? Is it a financial unit? Are we long or short change in prices? What is the direction of these different sources of inflation that we either have explicitly taken or done as a consequence of other decisions? Which ones are the big ones? Which ones do we really need to understand scale, and what is the depth of their respective markets, so to speak? And I think the two most important ones in this kind of, MRI for inflation are these bets that we want to take or need to take as part of our business strategy? Either of which, an affirmative action to either of those requires a forecast. It's unavoidable. If we're going to make bets, we've got to make forecasts on these things. As uncomfortable as we may be. And then finally, if the answer is yes, that we do need to take these bets and the big ones, how much do we retain and how much do we lay off and how do we do that? Mm-hmm. So this is all done through the lens of price changes and cycles for price changes associated with these different types of units. So that's the framework that I use. It kind of like avoids errors of omission, It tells you where there's orders of magnitude as opposed to smaller things. Because I think that really that's what should direct any kind of inflation strategy, is that context. So that's the approach that I take.
You know, I'm fascinated by, I'm always fascinated by frameworks. Charlie Munger is, sort of famous for having sort of his list of mental models, and that's kind of what we're trying to get at here, is sort of your mental model. And by the way, I like MRI better than audit. I mean, neither one of those is great things, but in finance here, we just audit just makes me
I like being a radiologist more than an auditor. It's
really, really difficult sometimes. And look, I mean, there's a whole bunch here to go. And one of the things I want to return to maybe a little bit later is the question of unit with the physical and the financial, because I think that there's probably some interesting ways to think about bringing those pieces together. But let's, you in this list, one of the bullets is, what are the big ones in the depth of their markets? And so I guess I'd like to start there and ask, are there some of these risks that are easier to hedge? And how do you think about hedging or retaining those sorts of risks?
Sure, that's a central question. So why don't we I thought it would be helpful to kind of use an example of one that's specific and go through what I think are the ways it can be managed.
Got it.
The answer to your question, are there some that are easier than others? Clearly, it's yes, and that
no, they're all exactly the same.
Yeah. And the easier ones, in one respect, is because the unit of risk has clarity what it is. And so let me be more specific about that. With example would be like a pallet of plywood or workers' comp rehabilitation program for let's say the same injury, as opposed to something risk that's more ambiguous, like a litigation risk or something like that. So the ones that are easier to manage and hedge are the ones where with regards to price risk, is the ones where the unit is itself relatively clean, let's say.
Mm-hmm.
So the example that I thought I would use to go through what I see as 6 methods is a basket of materials typically needed to rebuild a home after a weather-related cat event. So imagine that we've created a basket of those materials, building materials, and our risk is the price of those materials, or reward is the price of those materials, depending on what side of the trade we're on. So the 6 methods that I have thought about, 3 are really conventional, they're familiar, and the other 3, Mike, it would be like you and I go into the lab. And start to, put things together and pull them apart. And so I'll start with the familiar ones. One is actuarial input. This is the first line of inflation defense for underwriting, and it's been around for decades. Inflation protection in the form of the actuarial input is important. It's important to policy pricing, to product design, to setting reserves that are approved by the board. It's a component of all of those critical activities. It's part art and science. So this is the first line of defense for inflation, is the actuarial input. It's serious business for the company. Even the jokes aren't meant to be funny. So
they're actuaries.
Yes.
we don't want funny actuaries. That's a bad sign to begin with. So that's really getting to the pricing part of it, right? We're not yet hedging it, but I think what you're saying is that we better have a pretty decent idea of what the price of this thing should be because we're underwriting this risk.
Correct.
And if we come in and we're just totally wrong about the cost, then there's no hedging solution which is going to make it better.
Correct. And I think the way I think about this is we're charging for price escalation. It's what they call a load. We've put in a load for price escalation, and it's explicit, and it's subject to a lot of science. The models are advanced, complex, and there's a lot of good stuff out there, and you don't have to do much digging to find it. So that's one method. The other, this is more kind of the hedge category, and it's been around for years, would be conventional reinsurance. You basically lay off the pricing risk through, in this case, a cat treaty, where you've got effectively a syndicate of reinsurers, and the price escalation or stability is embedded in that treaty price. So it's there. It's all in. Not only the cost of rebuilding homes, but any risk associated with the price of doing so has been kind of fully incorporated into the negotiation of the treaty price itself. So
you're basically putting that risk then off. You're taking the risk entirely away from your insurance company, and now it lives at the reinsurance company. They're taking all the inflation risk along with the.
Well, kinda. You get a B for that back, not an A.
Hey, I'm a B kind of student.
So clearly the primary company retains some of that risk. It's the net exposure and lays off a lot of it because of the aggregation of it. And it's a principle of risk sharing. But whatever it is, it's horizontal, so to speak, in that it includes laying it off the pricing risk as well as the risk itself, the risk in the pricing. So that's another way that's been around for years that pricing risk is handled through integration in the CAT treaty with regards to this one example. The third and the more recent one, but it's not new, is just, assets in the portfolio, putting in various types of assets that benefit from different forms of inflation and types of inflation and environments, and maybe a general CPI index or an active fund around that. Are you familiar with those kind of things, Mike?
I've heard of some of these things.
Yeah.
I've heard of, but I have a question. We're talking about here building materials and so on. And if you want to hedge that building, the cost of rebuilding houses, what does an asset hedge kind of look like in that case? And I know this is just an example, and so maybe it's just not a great example, but how? Go ahead.
Perfect. So you've already entered the lab before I wanted to.
Okay.
But yeah, I think what I don't know if this is the right term for it, but what you're raising is the basis risk, so to speak, or alpha versus beta. There's different ways to describe this as a general inflation hedge, as opposed to coming back to this initial MRI. What are my, inflation risks on the business side or the operating side? Mm-hmm. So this is more the one I described as the more general protection of inflation, but there are these customization opportunities that I think can be explored. So before I do that, though, I think just one thing on the insurance asset management side, and I'm sure almost everybody listening to this is aware of this, is that I just want to pause and highlight the fact that insurance portfolios look very different from separate pools or ones that are more driven by pure risk and return, because they're the balance sheets of operating companies. Mm-hmm. They're subject to regulations, the business requirements, the accounting impact, jurisdiction, all these kinds of things. And these constraints bear on any strategy, asset strategy, including one that would be designed specifically in the investment portfolio for inflation. I just, always feel it's important to provide that context because it really does shape so much of what goes on.
So if I can see if I understand. So what you mean is that you might have a strategy, but in coming up with a strategy to hedge a particular risk, you need to take into account what kind of capital treatment you're going to get, or relief, or whatever the heck you call it. I don't know. And all kinds of other, whether they're eligible securities or
admitted assets, asset liability management, liquidity stress tests. Everything's got to be kind of run through that process. So while in an academic sense, you may do something different, the simple fact of the matter is these are assets of the balance sheet of highly regulated and complex and financial intermediaries. So
and does that add, it adds an extra wrinkle, right? So that if you have a great hedge between this particular liability and this particular asset, you've dramatically reduced the risk to the institution, but there's a good chance that the regulators won't give you any credit for that because they don't understand how that greatly reduces the risk of the institution. Is that fair?
Well, yes. Let me give you one example as a follow-on to that exact point. So let's just say that some of the inflation benefiting assets that you want are low in the capital structure, they're equity.
Right.
You're limited because of the reserve and capital charge much more with those kinds of assets than you are with fixed income. Even
if it's well matched with what you want to do on the liability side, it has an asset charge.
In fact, if you were to kind of look at this as a factor management, you're probably writing you're a lot more at risk for inflation in your pricing of your core business, your financial leverage, than you could readily accommodate on the asset side with those kinds of assets because of the capital charge. So there are these kind of tensions that come up from competing interests in the financial economics of an insurance company, and that's exactly the point that I'm making. And we'll talk a little bit. I'll refer to that a little bit more when we get into these lab examples, because I do think there are some ways to mitigate those scaling differences.
Now, do we need to put on a hazmat suit before we go into the lab, or is this
no?
How labby is this?
No. It's not. It's not going to be too bad.
Okay. Right.
I just wanted to point out that the assets are, the allocation can be different for these reasons. So the first one is one that you kind of set the stage for. It's a risk specific hedge, and if we return to this example of a basket of construction materials that are needed for rebuilding homes following a weather-related event, the insurance company could buy an at-the-money call option on a construction materials index. So, okay, we've written, property cover for both commercial or residential properties in prone areas. We've got reinsurance program, but last time we got squeezed on the cost associated with the supply chain issues and the run up in materials. So let's go along the risk and buy a call option on an index that gets us closer to that specific pricing risk, that inflation risk. The reason I use the call option is because you get leverage. You know what I mean? There's more leverage to it than just buying the index outright. And that in some ways connects the dots between this particular strategy and the point that we just made on scaling differences.
And you're spending some amount of premium and on an option. And whenever I hear the word premium, it makes me think about insurance. And so I don't know if there's a connection there, but figuring out exactly how much of the embedded premium that you've charged for the coverage that you're going to go spend on that hedge. I don't know if those are related concepts or not.
Well, they are, but
Tell me no.
I think the reality is that for the reasons I mentioned, capital being the most important, you're never going to cover it all, even if you wanted to completely neutralize it.
Right.
Which is why the availability of the price escalation being embedded in the reinsurance treaty contract is important. So it's like a portfolio of how to manage the risk. There isn't one that's going to cover it exclusively. And by the way, each one of these 6 opportunities, I'll call them, they have different costs, they have different depth, they have different accounting and capital trade-offs. But I think the answer for a company is looking at them collectively and putting together a portfolio of responses, not just one or the other. So the next.
So that's 4 risk. That's number 4 or first in the
Correct.
left, right?
Number 4.
Okay.
So the next one, and this sounds a little bit like a hammer, but it's been around for a long time. Is you exclude it. You exclude the price escalation risk with the coverage. So how would you do that? You could say, well, you could discount the premium that you would have charged for insuring property by the actuarial load for inflation in the materials. You just say, okay, we're going to strip that out from what we would have charged. We give the policyholders a reduced premium because they're not getting covered. They're only going to get paid, and we will pay for the losses, but at today's prices.
Mm-hmm.
So the price that they actually incur, whether it's higher or lower, will be a risk that they take, not us. And we've credited the policy for having reduced that risk-taking budget from the policy. And the reason it sounds draconian, but exclusions in insurance are commonplace. So,
Sure.
So for example, recently, it's come up a lot because of COVID. COVID pandemics are an excluded cover. There's been a lot, as you might imagine, this is what we do, a lot of litigation regarding whether COVID preventing use of facilities is the equivalent of property damage and therefore triggers a business interruption coverage. Those are some pretty animated discussions.
Better you than me.
Yeah, pretty animated discussions. But my point is that exclusions are a common tool that the insurance industry uses. And there's.
I was just gonna say, I mean, to me, I'm a risk guy. So to me, all of this is part of the discussion of which risk am I going to keep, which risk am I going to, ask the insurance company to take on. And there's obviously a cost to that. And you can see this with health insurance, right? That if I want to have a disaster coverage, the cost is very different than if I want to, have much lower deductibles. It's a question of how much of that risk am I putting off on the insurance company. So I don't, that's not, I don't have any problem with that conceptually. I would wonder about how easy it is to communicate that to the policyholder.
It's never easy, but there are some communications that are easier than others. So let me describe ones that I think are easier than others. So probably the most difficult is to exclude entirely a risk that the client has that you're not going to write. You know what I mean? That's, you're supposed to be in business to help people smooth out the risks and be the shock absorber. And you're saying, no, we're not going to do that. That's never a good conversation. So you're always looking at that as a last resort. You're looking for other ways, insurance-linked securities, other types of risk transfer that are in the ecosystem, because you're client focused. But nevertheless, there are times for a variety of reasons, capacity or not really understanding the risk, that you simply can't take it as a fiduciary. You just can't take it. The ones that are a little bit easier, Mike, are, and I actually like these, is when you mentioned deductibles and things like that. If there was a way to construct a deductible risk on price escalation, I think that's really appealing when there's a path to reducing that risk that is economic and pays for itself, and the use of a deductible as opposed to a complete exclusion, a large deductible, motivates the client to invest or change their behaviors or how they manage themselves in a way where they're going to want to benefit from reducing the risk in order to benefit from the cost benefit of doing so. So to me, because I'm a victim of my experience, I'll give you a more tangible example of that. Sprinklers. So yeah, this is just like if the cost of risk is associated with protecting a facility from fire.
Okay.
So you go into a facility and you say, you speak to the typical short attention span CFO who doesn't really want to spend that much time on this kind of topic. And you say, look, I'm going to get your attention. If you spend $30,000 in sprinklers, what it's going to do is it's going to reduce your property premium by $15,000. So you're going to break even in 2 years, and after that, you coin money. So it's better than a complete exclusion of the risk, and those are actually the ones that I think are the most productive. If there was a way to do this with regards to pricing risk and inflation risk, where the client was in control of that risk and could mitigate it with greater than their cost of doing so benefit to their insurance premiums, that's a win-win for both parties.
Yeah, I guess you'd have to have a company that could offer an individual, inflation protection overlay.
Correct.
Right, but offer it to the individual.
Right.
And this, I guess we're getting further into we're going to come up with a number 7 on the lab list here if we keep talking. So maybe, okay, well that's good. Is that number 6?
No, it isn't. Yeah.
I was thinking that maybe we're skipping this number 6, which I don't think we know yet, and we were going to add a 7. But the idea being that insurance company could team up with a actually, you and I have talked, an inflation reinsurance company.
Correct.
Where a company offers a specific inflation hedge to the individual, and then the non-inflationary indemnification. I'm making up words now that I don't know.
That's good. Yeah.
Is that good? All right. That stays with the traditional insurance company. But anyway, I don't know.
That's kind of what we were discussing, like the risk specific hedge. You strip it out and client retains it, and you basically insure indemnification.
And I guess there might be, especially getting back to what we were talking about and how the regulators, may or may not give good treatment to the insurance company for certain of these hedges, to the extent that you can take that hedge and give it to an individual who doesn't have an insurance regulator to deal with, then you've still solved the client problem, but you've moved it into a regulatory sphere or out of the regulatory sphere that's painful.
Correct. Yeah.
I like that. So
item number 6 is kind of like a little variation on the risk specific asset hedge, and that's a swap program. So you could, in this case, take the return on a construction index and then swap it against somebody who might want something, a risk that well and you're willing to sell. Let's say the return on the aggregate, fixed income aggregate. You might take the return, and they may be very willing to give it to you, from, let's say, a construction company that is managing price risk on materials all the time. And so they're going to be aggressive. They're going to be happy to trade that risk to you because they know it. And you're going to swap the risk that you know well to them. And so you do a swap and you create a program of swaps on your specific inflationary risk sources, as we described earlier, from that inventory. And you can do this in a fund. And this avoids the need of some of the things we've talked about before, is if you create a specific index, like for medical inflation, you need to create a market. You need depth on both sides. It needs to be tradable. And those are all great long-term answers to managing inflation risk. A series of indices associated with particular types of inflation. But in the interim, like a bespoke trade between two parties is not a bad interim solution to it. Well,
that's how the interest rate swap market got started, right? I mean, it was
right.
World Bank, IBM that had offsetting risks that, just had an agreement between them. So.
Right. So that could be kind of like the way you start this out. You say, where are our big inflation risks? And who would sell us an index on it? And we'll swap it, because that way it's more of a net exposure, and there may be less capital associated with it on a net basis that way, as opposed to just going long the index, kind of like a hedge fund with leverage. So that would be item number 6. So you have these conventional ways of doing it, the actuarial load, the transfer through reinsurance, just putting in some general inflation hedging assets in the portfolio, and then you can get down to much more specific and idiosyncratic inflation pricing risks through a specific asset hedge, a policy exclusion, or a swap program. So this is kind of like the family of ways that this particular pricing risk could be addressed.
So how many insurance companies actually think like this or do anything like this? So you've been at some big ones, but I know you also talk to lots of insurance folks. And I just wonder, I mean, obviously 1, 2, and 3 are pretty common. Does anyone think about 4, 5, and 6?
Oh, I think they do, but I think that it's got to be a company that can see a path to doing it through these other constraints. So they may be in a jurisdiction, they may not be a publicly owned company, they have some latitude as a private company. So I think the ones that have put themselves in a position to consider this, in some ways, that's the reason they've put themselves into a circumstance where they can consider some non-traditional approaches, have done that for this very reason. So they are thinking about these kinds of methods and techniques, but those that are much more constrained by virtue of how they're set up, who they're owned by, who they're regulated by. And then the other thing I would say, Mike, is that let's call this, for the sake of discussion, one form of customization. And insurance portfolios are customized for multiple reasons. We referred to some of them earlier. And they all compete against one another for which customization has the greatest benefit, which one is priced for the greatest return. And this is something that I've spent a lot of time on, written about. It's called active customization. So there are some cases where I think the culture of the company is designed to think about things like an inflation, like these other more technical answers than the conventional ones, and they do, but they would come at the expense of other forms of customization that are of paramount importance or have better economics. So they just basically say, well, for the time being, these inflation strategies just don't make it for us because these other forms of portfolio customization have much more importance and better economics. So the answer is yes, companies do think about this, but not all pursue it for the reasons that I mentioned.
And I would think that for the last quarter century, the whole question of whether or not there was any demand. I've spoken to life companies about, offering inflation adjusted life insurance and inflation adjusted annuities. And there are a few that occasionally will do it, but they don't do it terribly well. But one of the reasons they always give is, well, there's never, no one's ever cared about it. They haven't cared about it for a long time. And I suspect that the demand and the interest in these things is higher now than there had been in a quarter century. But
sure, it's the shiny object today. I mean, inflation is big.
Come on. I hope it's more than that.
Only kidding, Mike.
My entire existence, you just call it shiny object.
I just couldn't resist poking you a little bit. That's how we roll. But I think that it's got and it should have more attention. But here's a global statement. It's a generalization, which means by definition it should be subject to question. Is that I think the property and casualty industry now is more concerned about the magnitude of risks more than their pricing. Let me explain that. So it's much more important and unfortunate to realize that you have 5 times the aggregate exposure to, let's just say, wind-driven storms than the fact that how you are pricing it is going to be undershot by 5% versus 10%.
Right.
That's important, and I'm not dismissing it. But right now, with the emerging risks going on, I think what is in the headlights are, do we really have our arms around the magnitude of these units and how big the exposures are, more than do we have them precisely priced for inflation or not?
You know what? I mean, and this is something that I've said for a long time. Inflation has long tails, and so it's if you look at accounting for that risk in the insurance company via capital, and as opposed to reinsuring or doing something that you're just going to absorb whatever this inflation risk is. And that's what a lot of insurance companies have done, right? For a lot of their risks, is they just simply say, it's not a big enough risk if inflation goes from 2 to 3, whatever, and we've got some issues, but we have a lot of capital for that kind of thing. And the problem is, to your point, and especially now, people are realizing that it doesn't go from 2 to 3, it goes from 2 to 3 to 5 to 8. And the burden on our capital of moving from 5 to 8 is bigger than it was from 2 to 5. And so you get this non-linear effect. And actually, I guess, like you're seeing on banks and fixed income portfolios right now, but it's the non-linear effects. And I think that's what you're talking about, is that it changes the whole scale of the risk.
It does. Now on exposures or underwritten lines where the scale of it is you're more comfortable with it. It's kind of like the distribution is pretty tight. You may be wrong a little bit one way or another. Then that elevates the importance of pricing it, and risk assessment. So there could be some long tail lines where the scale of it is fairly certain. It's scrubbed down well, it's understood, it's not going to vary that much. And that's where, like spread businesses, it's where you do want to get the pricing right. So I think that there are different circumstances where pricing is much more important than others, and that would be one of them. So I don't want to kind of completely dismiss it for them.
Sure. Well, look, I mean, there's only so much we can cover in a, 40, 50, 1 hour, long program, but I think we've covered a fair amount of ground. Is there anything else you feel like we ought to add? I mean, I don't want to make this a 3-hour, podcast. We can always, come back and do a second episode. But is there anything else you want to add or, is there anything you want to talk about what you're working on or anything like that?
I think the only thing I'd add is what I've said. I think this is an important topic, and I'm glad that you raised it in the context of the insurance industry, Mike. So to the extent you can come up with these other kind of practitioners in this series of how it gets actually implemented, I think it's a great idea, and applaud your efforts in that regard. With regards to what I'm working on, I'm still I'm doing board work and consulting work, and I think that I'm still fascinated by this business, and in particular the puzzles that confront us, and we know that they're there because we keep repeating the problem, and those are the ones that draw me, and so I like to work on those. Also, the trends that I don't think have been the full implications of industry trends have been scrutinized and evaluated. So I like that kind of, wait a minute, let's make sure that we've got this right. I like to do those kinds of things. And in that regard, the next two steps, once I've got some of those kinds of interesting projects in front of me, is step number 2 is figuring out the right question. I spend a lot of time kind of thinking about, well, okay, this isn't a challenge, this is a problem. What is the right question? Because I believe that when you get the question right, you're going to get the answer pretty quickly. And then the last step is I then have this network of people that, like you, where I call up and say, hey, I have this question. Will you help me answer it? And fortunately enough, they often say yes. So it's really a fascinating kind of process for me, and those are the kind of things that I'm still working on.
Well, we're all caught in your web. We're all caught in your web. Just to bring it full circle here. Look, one of the things I've always loved about you is you've got this great intellectual curiosity of things that are outside of just right in front of you, and that's terrific. But also, you have this tremendous capacity to get really, really deep. And I guess a chess analogy, you seem to be able to think 5 moves ahead. Not necessarily with respect to a process playing out, but you think about layers deeper about things than I ever do. And so it's nice to be able to be involved in some of those early layers. And I really appreciate it.
Thanks, Mike. I've in all honesty, I've learned that kind of approach from those around me, and so it's been a real learning curve for me, and that's where it comes from.
Well, listen, I really appreciate you taking the time to be on the podcast today. You're really going to love the creative way I edit this and put it together in ways that you have no idea. No, I'm just kidding. It probably is not going to be very little editing, I suspect, because I'm not a very good editor. But anyway, thanks very much for coming on today. Okay, my pleasure, Mike. Well, that's all for today's podcast. Please like, subscribe, refer others, and all those other things. You can contact me at inflationguy@enduringinvestments.com. Subscribe to the blog at inflationguy.blog. Follow me on Twitter at inflation_guy, and visit Enduring Investments if you have an inflation challenge. But most importantly, defend your money. And if inflation is coming for you, remember, you know a guy.